Imagine taking the ultimate global crisis playbook, the one that has perfectly predicted investor behavior for the last 50 years, and just throwing it directly into the shredder, because that is exactly what global capital is doing right now.
It really is. And welcome to the Friday edition of Financial Candy. It is July 3rd, 2026, and the markets heading into the holiday weekend are throwing off signals that, honestly, defy every historical reflex we rely on.
Yeah, usually when geopolitical tensions spike, like the ongoing ripple effects from the Iran war we're seeing, you expect a certain predictability. Capital is supposed to panic, flee the risk, and run straight into traditional safe havens.
Right. You would typically see institutional money park itself in U.S. treasuries, or they'd load up on physical gold or flood into the Japanese yen. I mean, that flight to safety is the bedrock mechanism of global finance.
It seems that when the geopolitical temperature rises, the desire for capital preservation just completely overrides the desire for yield. But the trading data for early July shows that mechanism is completely breaking.
It is. We're looking at a financial X-ray that simply does not make sense if you were using historical patterns. Instead of investors buying the yen for safety, the Japanese currency has actually collapsed to multi-decade lows.
Yeah, it's hovering around 162 against the dollar, which is
Yeah.
wild. And gold, which is supposedly the ultimate historical refuge when things get unstable, it's fallen sharply from its peak back in January.
And U.S. treasurers are just sitting there without their usual safety-driven demand. The underlying logic of a safe haven relies entirely on trust and stable purchasing power. But two massive economic forces have completely dismantled that logic this year.
And the first one is inflation, right? You have inflation fears combining with persistently high real yields.
Exactly. If inflation expectations are creeping up, locking your money into fixed-interest government bonds means you are basically willingly signing up to have your future purchasing power eroded.
So treasuries stop looking like a safe harbor and start looking like a slow leak, especially when the U.S. federal deficit is tracking at, what, roughly $1.9 trillion for the 2026 financial year.
Yeah, about 1.9 trillion. That is roughly 5.8% of GDP. And that massive deficit introduces a real question of debt sustainability, which strips away the blind faith aspect of government bonds.
But the other force you mentioned seems to be pure distraction, because if I am holding a 10-year treasury yielding maybe 4.5%, but I am watching AI-related stocks like NVIDIA, Intel, and TSMC print astronomical double-digit gains in a matter of weeks.
Safety feels like guaranteed wealth destruction at that point.
It does. It is a bit like disconnecting your smoke alarm because you're just too engrossed in a really good movie. You know the risk is there, but the AI stock show is just too lucrative to walk away from.
The opportunity cost of hiding in a safe haven has simply become too high. Investors are perfectly willing to absorb the geopolitical risk because the technological upside is unprecedented right now. The friction of global instability is basically being paved over by the sheer liquidity generated by this tech boom.
I have to wonder about the end game of that liquidity, though. All this tech wealth being generated on screens eventually has to materialize in the physical world. And looking at the data, it seems a massive portion of that cash is flowing directly into luxury real estate, just completely ignoring local policy friction in the process.
Oh, absolutely. Earlier this week, a newly implemented pied-à-terre tax officially took effect in New York City. It targets non-primary residences valued over $1 million. And real estate developers were practically screaming about the Mamdani effect.
Right. They predicted this tax would cause an immediate catastrophic flight of the ultra-wealthy down to Florida.
But the transaction data tells a completely different story. In June, 126 contracts were signed for Manhattan apartments, priced at $4 million or more.
Wow.
And if you look at the ultra-luxury Tirso condos priced between $10 million to $20 million, sales surged by 55%. The average Manhattan apartment price just hit its second highest level ever, sitting at roughly $2.2 million. The predicted exodus entirely failed to materialize.
Which is wild, because a tax is fundamentally designed to alter behavior. It creates friction to cool a market down or redistribute wealth. You would assume a $98,000 annual tax bill on a penthouse would make any rational buyer hesitate or, look for a tax haven.
You would assume that, yeah.
The fact that buyers are just swatting this tax away like a minor annoyance suggests the traditional rules of price sensitivity are completely suspended at that income bracket.
Well, when a buyer is sitting on a massive sudden windfall from a tech IPO or an AI stock rally, their behavioral math shifts completely. They're operating with extreme liquidity. These luxury properties are being purchased entirely in cash.
Which means these buyers are bypassing the friction of 7% mortgage rates altogether.
Exactly. When you have that much capital looking for a physical home, optimizing your market timing and securing a prime, finite asset matters infinitely more to you than the carrying cost of a new tax.
The liquidity makes them completely numb to the penalty. You don't uproot your life and flee to Florida. You just pay the toll and buy the penthouse because you have the cash reserves to absorb the hit.
It is fascinating that ultra-wealthy buyers can simply buy their way out of a tax friction. But we are seeing this exact same dynamic attempting to invent new tolls and extract capital from captive markets play out on a massive global infrastructure scale right now.
Oh, you mean the situation in the Middle East? It is a prime example of attempting to engineer a new bottleneck. Oman, which historically maintains strict neutrality and acts as sort of the Switzerland of the Middle East, is currently in high-level talks with Iran.
And they are attempting to establish a new maritime security order that could ultimately impose transit fees on the Strait of Hormuz.
Which is huge. A toll booth on a waterway that handles roughly 20% of the world's global oil supply alters the baseline math for global energy overnight. But legally, sovereign states cannot just put up a toll booth in international waters.
No, they can't. The international principle of transit passage guarantees vessels the right to move through straits without being charged simply for existing in the water.
And Oman and Iran are keenly aware of that legal barrier, which is why they are attempting a highly calculated semantic workaround. Rather than calling it a toll or a transit tax, they are floating the concept of service fees.
Right, they argue that the geopolitical instability requires enhanced escort services, environmental monitoring, and insurance verifications. And those administrative services, supposedly, require compensation from the vessels utilizing the strait.
It's like your landlord suddenly deciding they can't legally raise your rent, so they start charging you a mandatory hallway maintenance fee every time you walk to your front door. It's a semantic loophole designed specifically to extract capital.
And unsurprisingly, the U.S. is pushing back heavily. Treasury Secretary Scott Bessent has publicly urged nations to reject any effort to disrupt free commerce, and the Trump administration has threatened aggressive sanctions if this framework becomes a reality.
There's a very specific timeline driving this tension, too. A memorandum of understanding was signed on June 17th, which established a 60-day negotiation window.
And during this period, Iran is restricted from imposing any immediate tolls. Oman is utilizing a diplomatic tactic known as strategic ambiguity. By keeping the exact parameters of these potential fees intentionally opaque, they avoid immediately alienating either Washington or Tehran,
while still maneuvering to secure a massive financial cut for their own treasury. I look at the oil markets, though, and they don't seem to be pricing in the threat of a 20% global supply bottleneck. If a rocket hits a tanker, oil futures spike instantly. But a bureaucratic service fee seems to go entirely unnoticed by the trading algorithms.
Markets have a documented massive blind spot when it comes to gradual governance risks. A physical blockade is a sudden explosion. It's easily quantified and priced.
But a slow rollout of new maritime compliance costs, creeping insurance premium hikes, and mandatory administrative fees is a slow boil.
Exactly. The market consistently fails to react to this kind of administrative friction until the operating margins of global shipping companies are already bleeding.
Understanding that difference between a sudden shock and a slow structural change is vital for anyone trying to navigate these markets. And just a quick note on that front, if you want to understand both the market side of these global stories and the human side, you can find Financial Candy, Brain Candy, and classic audiobooks at clarineratio.com.
But going back to that friction, the ability to absorb these slow-boil structural costs is highly dependent on your capitalization. Global oil shipping conglomerates and Manhattan luxury condo buyers have the liquidity to adapt to new fees without altering their core behaviors.
Everyday household budgets, however, face a completely different economic reality when friction increases. We are seeing that breaking point clearly in the healthcare sector right now.
We really are. The latest data from February 2026 shows a massive plunge in Affordable Care Act marketplace enrollment. The numbers dropped by roughly 3 million people.
That is a 13% decline, bringing the total down to 19.2 million enrollees. When a federal program loses 3 million participants in a single cycle, it indicates a structural failure, not just a seasonal fluctuation.
And the political framing around this decline is entirely fractured. The Trump administration points to a massive, deliberate crackdown on fraudulent enrollment practices. The Centers for Medicare and Medicaid Services recently canceled coverage for 250,000 individuals.
because they were allegedly signed up without their active consent by brokers trying to harvest commission fees, right? So the administration argues the system is simply being purged of phantom accounts.
But the nonpartisan health policy experts are looking at the exact same data and pointing to basic household economics. The enhanced premium subsidies that made these plans viable for middle-income earners officially expired at the end of 2025.
And without those federal subsidies acting as a buffer, the average premium skyrocketed by 114%. The out-of-pocket cost went from an average of $888 in 2025 to $1,904 in 2026.
The cancellation of 250,000 fraudulent accounts is a real factor, but it mathematically cannot explain a drop of 3 million people. A 114% price hike forces an immediate consumer ultimatum.
Because when household budgets are already stretched by cumulative inflation across groceries, energy, and housing, an expense jumping to nearly $2,000 annually moves healthcare from an essential utility to an unaffordable luxury.
You'd assume a 114% premium spike would just cause people to shop around for cheaper, lower-tier coverage with higher deductibles. But a 13% mass exodus tells me this isn't about comparison shopping. This is a hard wall.
People are looking at the new price tag and simply walking away from the system entirely because the capital just does not exist in their checking accounts. The friction breaks them. And, young Americans aren't just opting out of institutional healthcare systems due to financial pressure. They're increasingly opting out of marriage.
Yeah, the demographic data reveals a fundamental shift in how the next generation approaches financial and social milestones. Recent surveys indicate that only 37% of Gen Z respondents view getting married as an integral part of the American dream.
The cultural perception of marriage has transitioned from a cornerstone to a capstone, meaning, historically, marriage was the cornerstone foundation. You get married young, you pool your meager resources, and build your financial life together from the ground up.
Now, it is viewed as a capstone, a luxury achievement you only unlock after you have independently secured your career, built your savings, and achieved financial stability.
But delaying that partnership has severe, measurable financial consequences. When you look at the median net worth of single people under 35, it sits at roughly $22,000 for men and a startlingly low $9,000 for women.
When you compare that to married couples in that exact same under 35 age bracket, their collective median net worth is nearly $114,000.
The sheer scale of that wealth gap implies it is about far more than just having two salaries instead of one. Attempting to navigate an inflationary economy solo means you are absorbing every single unit of friction entirely on your own.
Single earners are leaving incredibly powerful, invisible financial mechanisms on the table. By remaining independent, they forfeit joint tax filing advantages. They lose the ability to consolidate and lower health insurance premiums.
And most importantly, they miss out on the economies of scale in housing. A married couple pays one internet bill, they heat one living room, and they combine their income to access significantly higher borrowing power for a mortgage.
The single earner is paying a massive premium for their independence.
It's the equivalent of trying to bootstrap a capital-intensive startup entirely on your own. You could easily bring on a co-founder to split the commercial rent, share the operational stress, and double your working capital, but instead, this generation is choosing to solo fund the entire enterprise.
And the data proves that building wealth in a silo is exponentially harder. Recognizing the hidden costs of going it alone is a lesson that extends far beyond personal finance, though. The corporate sector frequently falls into the exact same trap, assuming they can engineer away the need for human partnership to cut costs.
Ford Motor Company just provided a perfect case study in how attempting to algorithm your way out of human experience actually destroys capital. Ford has been dealing with an absolute crisis in manufacturing quality for the past decade.
The scale of the problem is staggering. They've issued 53 recalls affecting over 12 million vehicles just in this year alone. CEO Jim Farley made a massive structural turnaround in quality control his central mandate.
And the financial dividends of that strategic pivot are finally hitting the balance sheet. Ford managed to slash their warranty and materials costs by a massive $1.5 billion in 2025.
The broader automotive industry is validating the internal numbers, too, with J.D. Power officially ranking Ford as the top mass-market brand in initial quality as of late June 2026.
The operational mechanics of how they pulled off a $1.5 billion turnaround is what reveals the real lesson here. Initially, Ford leaned heavily into artificial intelligence, rolling out advanced AI tools on the assembly line to detect microscopic manufacturing defects early in the process.
They assumed the technology could replace the expensive veteran staff they had previously pushed out. But the AI algorithms lacked context. They were flagging irrelevant anomalies and missing structural flaws because the software didn't understand the physical nuances of automotive engineering.
The initial push for efficiency created a massive liability. By firing their most experienced, highest-paid veteran staff to clean up the payroll, they eliminated their institutional knowledge.
And that specific efficiency cut directly contributed to a staggering $4.8 billion in warranty repairs back in 2023. The AI was essentially flying blind without human supervision.
To fix the AI, Ford had to completely reverse their staffing philosophy. They brought back the veteran human engineers, the highly experienced staff they affectionately call the graybeards, and embedded them on the line to supervise the younger technicians and physically train the AI models on what a real defect actually looks like.
True productivity in 2026 requires human wisdom to calibrate the artificial intelligence. You cannot simply buy a software package to bypass the friction of manufacturing. You need the human partnership to make the capital investment actually function.
Whether it is a Gen Z worker trying to build wealth without a spouse, or a legacy automaker trying to build trucks without veteran engineers, trying to engineer around the cost of human partnership almost always backfires.
It really does.
And as we head into this July 4th holiday weekend, we are getting a very stark reminder that some limits simply cannot be engineered away. A blistering heat wave has settled over the U.S., pushing temperatures to 105 degrees across major East Coast population centers.
Extreme physical weather translates into immediate financial volatility within hours. Millions of residential air conditioners are cranking up simultaneously, pushing regional power grids to their absolute physical limits.
Major grid operators like PJM have been forced to issue federal alerts demanding immediate reductions in electricity consumption. Because the infrastructure is maxed out, the wholesale spot, electricity prices have spiked violently.
Yeah, as of Thursday, prices surged 243% in New England and 101% in New York City. We've spent this entire conversation analyzing how markets and individuals attempt to bypass friction.
Oman tries to rebrand international transit laws into service fees. Manhattan billionaires drop $15 million in cash to swat away local property taxes.
Young Americans delay marriage to avoid traditional financial structures, and corporations deploy AI to avoid paying veteran salaries. Human behavior is incredibly adaptable when facing economic pressure, but the physical world has hard boundaries.
You can use extreme liquidity to absorb a tax penalty, but you cannot negotiate with a stressed power grid. When the physical infrastructure hits maximum capacity, the demand outstrips the supply, and the price is the price.
You can disconnect the smoke alarm to watch the movie,
Yeah.
but eventually you still have to deal with the heat.
That's Financial Candy for Friday. We'll be back on Monday. Have a great weekend, and check out Brain Candy if you need something to listen to while staying cool inside.